Hi, Doc. It's great to see you again, and welcome back to another episode of the Money Mentor podcast with Chief Economist Dr. Andrew Wilson at My Housing Market. We've got plenty to unpack again today, and it's great to see you as always, Doc. How are you?
Yeah, I'm good, Glen. How are you? We always have a lot of information. We've had some interesting developments this week out of the US, actually overnight, that the latest retail sales data out of the US came in very, very hot. Once again, well above market expectations. And the head of the Fed, Mr. Powell, has backtracked on his previous predictions, and he's now starting to say quite openly that they're unlikely to meet their inflation targets in the time frame originally anticipated. And that means that they're less likely to have those interest rate cuts. And we've been discussing this for some time, that it was extremely premature to be talking about interest rate cuts given the data. The Fed's been caught out. They were predicting 4 interest rate cuts this year. We're now down to 2, and things are looking bleaker in terms of the outlook for inflation. So as we've been saying, there's just no case going forward for lower interest rates, and just following the sort of the trend that inflation has followed over the last 2 years in falling. You have to look a little bit closer to the data and see exactly why the trends that inflation has been falling. And it's just been that adjustment process from the COVID stimulus package, when we had so much demand, not enough supply. We've gone through that adjustment process, but we've still got issues such as the price of oil, which has been rising. Cost me a lot to fill the car up the other day, let me tell you.
We're all feeling the pinch there.
Yeah, and I think there's more to come. We're still under $90 US a barrel, and I think once we get to, if we did break through that $90 US a barrel margin, I don't think it would take much to move up to $100 US a barrel, and that would mean $3 a litre for petrol, Glen, which is a little bit disturbing, because we are unlikely perhaps to have the sort of support that we had when petrol, when the price of oil was, above $120 US a barrel from the government. So I guess that's always higher. Fuel prices always work their way into inflation anyway, because of course transport costs and just general costs to fill up the car mean that you're looking to increase your wages, and in a tight labour market, that means more leverage against the boss to try to get more money to cover your higher fuel costs, as well as those higher transport costs, which employers have to cover, and likely through higher prices. So all these scenarios, and that's just fuel, don't augur well for, particularly for those that have been talking about lower interest rates. And you can bet your bottom dollar, Glen, that all those that have been predicting lower Australian interest rates will be predictably jumping off that bandwagon and changing their predictions. I mean, some of the banks that have been predicting that, the roller coaster ride of bank predictions is mind-boggling. I'm dizzy just trying to keep up with it, because prices are falling. Oh no, they're going to rise. Interest rates are going to be cut. Oh no, they're not going to be cut. It really is a lesson in not rationalising the sort of things that we hear in the media. But so that latest news is certainly putting the near-term cut in interest rates in the US backwards. And as we've been saying this for quite a while now on the podcast, that really there's been no justification for these predictions other than just a cheap headline. And unfortunately, we get a lot of cheap headlines these days. So that's the latest news, Glen. Going forward, we've got some interesting data today. We're going to, or some interesting slides today. We're going to look at the latest investment returns. Of course, we've had the update of the March update for prices and rents. So we're going to put that together and see what investors are getting as a return. We're also going to look at the latest house building costs, which have been a negative for inflation. We know that, but we've got some better news there for house building costs. And just as something a little bit different this week with the house building costs, we're going to look at the contribution of the capital cities. So which capital cities have the highest house building costs, which is quite interesting to look at that. So, lots to look at. And of course, not forgetting, we've got the latest regional house prices update for March. So perhaps we should get going. There's a lot to cover and we don't want to be here all day. We could be, but we'll have a look at the latest data. So it is this week in property ending Wednesday, April 17th. The year is moving on. We're a week away from Anzac Day, of course, and that's the last of our April holidays. It's been a big month for holidays, as it always is April, and it has some impact on housing market activity, particularly in auction markets. And we'll have a look at the latest auction market results, which of course are affected by the school holidays, and school holidays really are being undertaken at the moment in most states. I think all states. Some are just coming towards the end and have just started off. So this week we're going to see those latest residential investment returns, latest house building costs, the latest regional house prices, and the latest auction results. So let's have a look at those investment returns. So firstly, we're going to look at gross yields, Glen. So this is the return on, and we're using the March data here. So it's the March median asking rent for each of the capital cities versus the March median house price. So it is what you would get as an annual return on that latest house price with that latest rent. And as you can see there, Perth providing the number one return. Now, these are house yields, of course, up by 4%, well ahead of Brisbane, 3.5%. Adelaide up 3.45%, Melbourne up 2.9%, and Sydney up 2.5%. We typically see lower yields for houses versus units, because the relationship between rents and prices in houses is a lot closer than it is in units, if you understand what I mean. And that's why we get those higher yields. But Sydney, as usual, with the lowest yields, but it is the market that typically provides the highest returns. And of course, it has a very significant mid to higher priced market. So that acts to drive down yields. But Perth, number one, over 4% for yields on the latest data. These are gross annual investment yields. And of course, these are gross yields. So these returns don't account for the other costs that are involved in a rental property, such as rates, your interest rates, and all the other bits and pieces, insurances. So these are gross investment yields. For units, as I said, units returns are typically significantly higher than houses, and we can see that clearly there. Perth, very high gross annual yield, 7%, Glen, gross annual yield for units in Perth. Of course, Perth has a smaller unit market, so a little bit of volatility in these results, but no such issues in Brisbane, which has a very strong result there, 6.46% gross yield. Good news there for investors in Brisbane units. And the Brisbane unit market is a very strong unit market. And we have Melbourne next at 5.33, then Adelaide at 5.2, and Sydney again the lowest at 5.1%. But I think it's interesting that those Perth yields, we always look at the yields of capitals that are significantly higher than the other capitals, and we think, okay, well, that's looking to perhaps preview a rise in costs prices, because the yields are too high. Therefore, it creates more demand because of those high yields, and that, of course, puts up prices, which pushes down yields. But the interesting thing here is, even though these yields are high and demand is strong, we're also seeing rents rise strongly as well, as we know. So even though you might have, in a sense, downward pressure on yields because of higher prices, that's being offset, Glenn, by higher rents that are keeping those yields quite high. So in a way, it's the perfect world for investors. They're getting a high yield, they're getting capital growth, and their yields are being sustained by high rents, and rising rents. But some interesting data there in terms of the gross investment yields for units, with again Perth top performer, but all those results are over 5%, which is a positive return for investors in this current environment. So if we look at the total investment return, so what we're going to do here is we're going to add those gross yields. So that's what you're getting as a return on your rental income. And we're going to add that to the capital growth that we've had over the past year. So that's your capital growth plus your investment income return, your yield. And look at these numbers there, Glen. Perth on top for houses, up by 26%, Brisbane 21%, Adelaide 20%, Sydney 13%, and Melbourne underperformer is 7%, because, of course, we know prices have been going backwards in that Melbourne market for houses. Well, they've certainly been steady compared to big rises in Perth, Brisbane, and Adelaide. So there's some spectacular returns for investors in those smaller major capital city markets, and similar results there for units. Total returns for units, inclusive of gross yields and capital growth over the year up to March. Perth ahead 28%, 27% for Brisbane, Adelaide up 22%, Sydney 11%, and Melbourne up nearly 20%. Up nearly 11%. So look, strong returns there again for those capital city markets, and no wonder we've still got we have steady activity, rising activity from investors in the market, given these strong returns. Despite the fact we've had higher interest rates over the last 2 years. So we always put this one in a little bit cheeky. Let's have a look at how house prices have been doing versus the share market. We can see there that this is taken from the end of 2007, which was the peak of a very strong period there. So it's sort of been fair to the share market and fair to the housing market. We also had higher rates then as well. But you can see there that house prices have increased significantly more than the share market, with all odds up 14.2%, and Sydney the best performer, up by 197%. So that's a big difference, Glenn. But I've also put in the chart here. It's to sort of say, well, maybe it's just the share market per se, but it's not, because if we look at the US share market over that same period, it's actually increased by more than the rest. With those capital growth from house prices, and significantly ahead of the Australian performance. And it's I think it's interesting to see just how the Australian share market has underperformed compared to the US share market over that period since 2007, so 2007. So that's our investment return slides for this month. Interesting stuff. Also mentioned that we're going to have a look at house building costs. We run a monthly house building cost index, Glen, at My Housing Market. So we track house building costs. This data is derived from the ABS buildings data. But we got some good news, because look, we're looking at house building costs, two reasons. Firstly, it's a significant factor in the inflation rate. When the ABS measures the inflation of housing as a factor of inflation, it measures rents and it measures house building costs, not apartments, but house building costs. And we know that house building costs have gone through the roof over the last couple of years since the previous government's home builder policy, which created way too much demand for the supply that was around. We had a chronic shortage of materials and tradespeople, and that pushed up house building costs. So, it contributes to the CPI, the inflation rate, which of course contributes to the interest rate. But the other factor is, of course, higher building costs aren't good news for builders. And we are so chronically undersupplied with housing in this country, and most other similar economies are also, that this is the last thing you need is, skyrocketing house building costs if you're a builder, because it obviously constrains your capacity or your profit margin. So, but some better news over with the latest February data. we actually saw the index tick down. You can see how that index has really exploded since 2021 with that home builder policy. Just started to ease off a couple of months ago. Then we had a rise over January, but we've improved over February. This is seasonally adjusted, or it doesn't need to be seasonally adjusted because it's raw data. But we've tracked down, so that's a good sign there in terms of the outlook for house building costs early days. But the important thing is to look at from the inflation rate is to look at the annual growth rate on the quarterly data, right? Because that's what the ABS looks at. And the good news there is that our annual rate is now falling, now under 6%, 5.6% was the growth, the quarterly growth in house prices over the past year. And you can see how far down that is compared to the peak of the growth rate, which was 22.7%, which was just unbelievable at the peak of that demand surge. We're still well above where we were in the sort of pre-COVID period, but we're heading in the right direction. So that's good news for inflation, which is good news for interest rates, and it's also good news for builders that that house building costs are starting to trend lower. But it has been a bit of a bumpy ride over the last few months, so we need to keep a watch out on the data as it comes through to see if we can sustain that. Now, I've put the sub-index in here, and this is the capital city indices or index for house building costs. And as we can see, there's a bit of a difference there in the performance of the capital cities over February. The quarterly result there, we have Sydney house building costs up 9.9%. Now, we have seen an upswing in activity in that Sydney house building market. So maybe there's some good signs there, other than not good being higher costs, is that there's more activity happening in Sydney. But Sydney is, of course, for house building, an underperformer compared to the other capitals, particularly Melbourne, Brisbane, Perth, that build more houses than Sydney. So there's always that upward pressure on costs. But we can see Melbourne level house building costs over the February quarter. Brisbane up around about the average rate. Adelaide down and Perth up as well. So Sydney was the big mover. The rest were slightly up and down. But other than that Sydney market, I think there's some better signs there, even in the capital city markets, that house building costs are starting to ease. And this sort of puts it all into context. This is the relativity index. So what this is showing is the February house building costs of each of the capitals, and using Sydney as a base at 100, we can compare the other capital cities. So Sydney at 100, it shows that Sydney is 23%, 22% higher than Melbourne, 30% higher than Brisbane, nearly double that of Perth and Adelaide. So high building costs in Sydney, as I mentioned, no surprise there. Sydney is the highest priced housing market in the country by a country mile, and that reflects in the higher building costs. And of course, there's fewer houses built in Sydney compared to the other capitals, and that creates that more competitive environment and puts upward pressure on prices in Sydney. But Sydney well ahead, average house building costs in Sydney well ahead of the other capitals. So something a little different this week. Now, we also said, Glenn, that we'd look this week at the top regional markets. So this is the March data. This is the 3 months to March compared this year compared to the 3 months to March last year. So this is the top performers in each of the major states and some of the minor ones. And we can see there that the Tweed is the top performer. And these are LGAs, local government areas. The Tweed is a top performer, up by 11.8% over the year, Glenn, and a median over $1 million now for houses in the Tweed. And of course, we shouldn't be surprised at that, because we know the Gold Coast market is very strong at the moment. And of course, the Tweed is picking up on a lot of that energy, and some of the affordability advantages of the Tweed are creating more demand. So a big result there for the Tweed over the year, up by 11.8%. Wollongong number 2, up by 8.4%, followed by Newcastle up by 8%. So those, I guess we could say those three big LGAs, and they are three big LGAs, Tweed, Wollongong and Newcastle, sort of leading the charge there for the New South Wales regions, with Maitland there, of course, adjacent to Newcastle, coming in there at number 4 at 4.3%. Interesting, we were talking about the energy that the Tweed is gathering from the Gold Coast. It's not translating further south with Ballina. It's interesting that Ballina has been an underperformer compared to the underperformer of all the LGAs, and yet Tweed, which is adjacent to Ballina, well, of course we've got Byron Bay in between, has performed quite strongly. So it does show the influence of the Gold Coast, the adjacent nature of the Gold Coast to those local capital city market, those local government areas. And we look at Victoria, and of course, when we put those all together, it looks around about the average strength of that Sydney market. Not as strong in those Victorian LGAs. The more affordable LGAs have performed the best over the year. Latrobe and Shepparton, rising reasonable levels over the year, but they are those more affordable options. And some of the higher priced options have underperformed, particularly the Surf Coast there. And Melbourne's higher priced market, prestige market, has really dragged the chain a bit over the last few years. And that's perhaps another sign, with the Surf Coast prices falling by 10% over the past year. And the Macedon Ranges, after being quite strong over the last year, has now started to ease off a bit. And similar story with the Mornington Peninsula, which is a higher priced market, prestige market. Its prices are down also. So certainly the Victorian regionals not performing as well as the Queensland, as the New South Wales regionals, but no surprise there, given that energy coming out of Sydney, which is quite positive, and the energy coming out of Melbourne, which is certainly not so positive. In Queensland, and we can really see the difference here. Very strong results across the board in Queensland. Townsville, after a number of years in the doldrums, is shaking that off to some degree, up by 22% over the year. Big result there. Rockhampton up by 20%, Bundaberg up by 20%. The Gold Coast, as we mentioned, very, very strong, up by 20% over the past year. Toowoomba also nearly 20% increase. Cairns, strong result, up 14%. We say that for all these markets. But you can see the difference between Cairns and Townsville. They used to track each other. And now there's, the best part there's over $100,000 between the medians in Cairns and Townsville. Just shows you how stagnant that Townsville market has been. And affordability is certainly driving prices higher. But it's really moved sideways over a number of years, whereas the Cairns market has continued to grow. But as I said, a big difference in the performance of the Queensland regionals compared to particularly Victoria, with all of them recording growth, and the Fraser Coast, the underperformer there, down by 1.8%. Smaller markets. Let's have a look at Tassie. The Tassie LGAs, Hobart and Launceston, of course, they're the biggest markets in Tasmania, LGAs. Good results there for Hobart and Launceston. Clarence and Glenorchy down, however. And in the Northern Territory, Palmerston and Darwin tracking each other, up just slightly over the past year. So interesting. And it's always interesting to see how the regional markets correlate with the capital cities. Stronger capital cities, stronger regional performance, weaker capital city performance, weaker regional performance. So I think that's quite an interesting comparison. And we always do say that when we do talk about the prospects for regions, is that it does reflect to a large degree what's happening in the capital city markets. So as usual, we're going to finish off with the weekend auction markets. We discussed school holidays at the moment. And of course, school holidays create distracted markets. And one of the big changes we see over the holiday period is we see a much lower proportion of higher priced properties going under the hammer. because those vendors, those sellers tend to be more or less on holidays and putting their decisions to one side. So we always see that. So, and of course, we see fewer numbers because of the distractions of holidays. But, one of the significant factors this year in our auction markets has been the high numbers of listings that we've had. And we've had quite solid clearance rates as well. And that's translated, which we'll look at shortly, that's translated into record sales for this time of the year, the actual number of sales. So we know we look closely every week at auction clearance rates because they're a very reliable forward indicator of what's happening generally in the housing market. You can see there in Sydney how auction clearance rates track house prices. Same story there for Melbourne. Auction clearance rates track house prices. Higher clearance rates, higher house prices. Lower clearance rates, lower prices. It's sort of logical, really, isn't it? But that's why we do focus on auction results, weekend auction results, because they give us a good sense of what's happening in the market. So last weekend, more solid to strong results, Glen, despite those school holiday distractions. And we look at the numbers, another big weekend, really, in Sydney, considering it's school holidays. 750 auctions, similar clearance rate to the weekend before. And when we look at the same weekend last year, Glen, you can see the difference again in auction numbers, significant higher auction numbers last weekend in Sydney compared to the same weekend last year. Clearance rates a little lower. We've got to understand that the market started to break out in autumn, in the mid to late autumn selling season last year. That's when we saw the real boom in Sydney. That was when all that pent-up demand that was created through 2022 through higher interest rates was being released. So we're not going to see the same sort of clearance rates this year through autumn into winter as we saw last year, because that was a breakout period of the market. That's when the market was rebounding. So it's actually encouraging to see that we're still getting, positive, solid, strong clearance rates, even though we've had all that growth last year at the same time. So Sydney, 71.8%, a good result for sellers there. Melbourne, again, higher. It was the second week of school holidays in Melbourne. It had higher numbers of listings compared to the previous weekend, and again, higher than the same period last year, but similar to Sydney, the same weekend last year, similar to Sydney, its clearance rate is lower compared to where we were a year ago. Brisbane, same story, lower numbers because of school holidays. Clearance rate was a little bit higher actually in Brisbane, which is positive compared to the previous weekend, but once again lower than where we were a year ago. Adelaide really bounced back strongly, even though it had certainly lower listings. Again, it was a very strong clearance rate back above the 80s, which we used to say just about was you could set your watch to an 80% clearance rate in Adelaide every weekend, but it hasn't been there for a couple of months, but it's bounced back there over a few weekends over the past month. And Canberra just starting to push up again. We're hopeful that Canberra market on current returns over the past 3 or 4 months, or certainly over the past 2 months, is now starting to improve on what was an underperformance compared to the other capitals over the second half of last year. And once again, those Canberra listings are higher than where they were a year ago. So we're going to normalise our markets, although we do have Anzac Day coming up next weekend, or not this coming weekend, but the weekend after. But, this again will continue to impact results because people will still be taking leave, and it'll certainly impact not this coming weekend, but the following weekend. So we really need to wait until we get into May before we get a normalised market, because all those different holiday scenarios, Easter falling on a different weekend this year, have to work their way through the system. But regardless of that, we can clearly see that, and we see the trends there, lower than holding so far over April in Sydney, but slightly lower than the year before. Similar story there in Melbourne, which is so far tracking higher in March compared to April, marginally higher. Brisbane are around about the same as where it's been, but again, lower than where it was a year ago. Adelaide picking up now, but again, similarly to the other capitals, lower than where it was a year ago. And Canberra still lower than where it was a year ago, but as I said, some positive signs there. As you can see with the March results that the Canberra market has shown some signs of starting to pick up after that subdued period over the latter part of last year. So you can get those auction results off my LinkedIn account, Doc Andrew Wilson. Every Saturday at 6:30, we send the headline results, each of the capital city results through. And then we have the full national report released through that LinkedIn account on Sundays at around about 9 a.m. So look for that. As I mentioned, we've had record auction activity this year so far. You can see that. Isn't that amazing? This is actually the number of sales. So we're putting together listings. We're putting together clearance rates to give us the actual number of sales. So look how far ahead auction sales are this year in Sydney, up by nearly 40% more auction sales. What a strong market. Melbourne up nearly 20%. Brisbane up nearly 30%. Adelaide up 15%. And Canberra still underperforming there, down by 4.5%. So that's a big lift in the number of people buying properties, which will be good news for estate agents who will be enjoying the commission, and good news for state governments that will be enjoying the stamp duty, those that have stamp duty. So this is why we say it's a very strong market this year. There's been a lot more transactions occurring. Prices growth not as strong, but although it has strengthened over March. But this is one of the reasons that we're certainly seeing a lot of buyer activity and a lot of seller activity as well over the first 3 months of this year. If you want to get a copy of that the latest national weekend auction market report, there is the QR code, which will take you to provide you with a link to the PDF copy of that national weekend auction market for last weekend, and that's the data of how to get it. As we usually finish off with Glen, and I can see the excitement building in your face as we talk about this wonderful My Housing Market Infinity Suburb Data app. And we have an app which is great. It tracks all the asking prices and asking rents nationally. We update it on a daily basis. That's a link to that's the QR code which links you to the app. You will have to get a password to access the app, and that password is available only through Infinity. But it's a great little app. You can discover what's happening in each suburb in Australia that has rental or price data. And as I said, it's current data. And we've got a little screenshot here to give you an example of what you can see. You can filter the app for price or rent. Here we've filtered for price. You can filter it for the states and the regions. Here we've filtered for the Sydney City region. And then you can filter for the suburbs in that region. We've gone for Blacktown. You can filter for the type of property. You can filter for a house, for a townhouse, or for a unit. We're looking at houses here. You can also filter it for the number of beds. So you can look for a 5-bedroom house. So we've done that here, and there are the results there. We give you the median price, the low price, the high price, and the number of listings. So it's a comprehensive insight into what's happening in each suburb that has data in Australia. And it's not just the median price, it's the high, the low, and it also tells you the number of listings there. And as I said, this is updated daily. So it's a great little handy app to have on your phone, just to sort of discover what's happening either in your neighbourhood or in a neighbourhood that you're interested in looking at. And we do exactly the same thing for rents when we filter it for rents, and you can see the same data there for Blacktown. We're looking at the high rent, the median rent, the low rent, and the number of listings, which of course is not very many because there aren't very many rental listings anywhere at the moment. So no surprise. Next week, we're going to look at the latest labour market data. We had a big fall in the unemployment rate last month. Will that be sustained this month? Again, that's not really good news for lower interest rates, let me tell you. We also will have the latest inflation data. So how's the inflation rate going? That will be for March. So we'll have both the monthly and the quarterly inflation data. And we're going to do something a little different, Glen, next week. We're going to compare Australia with the US and New Zealand on some of those key factors, such as inflation, interest rates, home building, rents, prices. So how is Australia going versus the US and New Zealand? So we're going to have a look at that one, which I think is very interesting. And you'll see it's a very interesting data set. So look out for that. And the latest weekend auction results. Of course, the Reserve Bank is not doing an interest rate decision every month from now on. It will do one next month, but it's not doing one in April. Okay, it's a holiday month. But, it would have been an interesting, conversation given what's happened in the US, what was happening at the Reserve Bank in relation to the prospect for interest rates. But we don't have interest rates for this month. We'll have them next month, but we'll look at that Australia versus US and New Zealand data next week. So if you want to look at all the data in this week's report, there is the QR code for it. That will take you to a link to our full podcast data as we've just discussed. So that's me, Glenn. We're done. It was a big show, as it usually is, and we're going to have some more info next week once again, which will be the day before Anzac Day, won't it? I think 2 days before, the day before Anzac Day. So we'll have a big pre-Anzac Day show. So I guess in a way, it's interesting that show we will see what's happening in Australia compared to the US and New Zealand. So a little bit of a Anzac Day flavour, perhaps we could say, with that data. Not intended. I just thought of that actually. So it's all good. So catch up with you then, Glenn. In fact, we'll be having, so it's all good, mate. So catch you then. Look after yourself this week. Thank you.
You too, Doc. Thank you.